Is it dead cat bounce? I love using that phrase, I have to say. First of all, what is that, and are we seeing it?
It's a bounce and a downtrend, and we think it's a little early to call the all clear just yet. The good news is the market's very oversold. Everything yesterday was climactic in nature. Volatility, number of stocks making new lows, number of stocks above moving averages, everything washed out to a point where you would expect to see a bounce. The problem in our work is that the trend has weakened. And that, for us, means the bar is a lot higher to get bullish again. We need to see a lot of internal improvement going forward. Today's rally, not that impressed with it internally. Advancing stocks only beating declining stocks by about 4 to 1. I need to see much better breadth skews internally to get pulled up again here.
So based on your technical analysis, what is the chances that we are going to see a so-called V-shaped recovery, this kind of snapback that mirrors the decline?
I think the more appropriate playbook is looking at what we saw in 2011. We had the primary low in the 2011 correction in August. Then it took a good 2.5 or 3 months before we undercut that low in October. That set a better base. It set a better stage for a rally into the back half of the year. And let's also remember where we are on the calendar. It's August 25th today. It's not October. The seasonal headwind, I think, is still at play here, and we should at least proceed cautiously over the next couple weeks.
We actually do have a S&P historical chart dating back to the last two corrections that we've seen, charting it against the 50, 100, and 200-day moving average. If we can get that chart up. Look at those last two sell-offs and then recoveries. Where are we in that cycle?
Well, I think the takeaway here is when we think about yesterday was the bang. But what we're waiting for is the whimper. We need the undercut, or we need the retest, or we need the period of repair after the damage that we've seen. Let's also remember that the moving averages right now, the 50 and the 200 on the S&P chart, are starting to flatten and roll over. It tells us the trend is starting to change here a little bit, and I think as a consequence of that, the bar or the threshold on a rally here has to be a lot higher than it would have been a year or 2 years ago.
Chris, I've got a chart here that you sent over that says we need to get more negative. Can you explain what it's showing and how you measure sentiment?
Yeah, well, when we look at the survey data, one thing that really hasn't gotten capitulative yet is the survey work. And I think the chart that we brought up is a survey from Consensus Inc., which is a weekly bullish-bearish survey, and it gave us a very good signal in 2010 and 2011. We don't have it quite yet. I'd like to see attitudes and headlines get a little bit more dire.
Talk about dire. Can we talk about the VIX for 1 second? Because that has been, as I mentioned earlier in the show, kind of a crazy move. Take a look inside my Bloomberg terminal. You see that enormous spike up. We're just over 40, excuse me, over 30 on the VIX, but that was a huge spike that we saw the last few days. But let me max it out for a second. And it looks pretty puny, well below the levels that we saw in 2009 and 2011. What are you expecting for the VIX as we continue to try and find a recovery here?
Well, let's remember, the VIX tells us what is happening, not what will happen, right? So the move in the VIX the last 3 days, largest 3-day rate of change ever, going back to 1991. So certainly price or volatility is at the moment very climactic, very oversold. I think that contributes to a short-term bounce, but I don't think it tells us a lot about what we can expect much beyond that. Remember, when volatility starts to go, it tends to stay elevated for a period of time, particularly, I think, given some of the macro headwinds out there. I wouldn't be surprised if the VIX stayed higher for longer.
I know you're a technical strategist, but I always have a hard time comparing what happened this week in August of 2015 to, say, August 2011, because there was a clear reason for the sell-off. S&P downgraded the U.S. 2009 was the crisis. So why does volatility spike in August of 2015? Nobody clearly, there's no single thing we can point to for the giant change in sentiment this week.
We can come up with a wall of worry, right? Whether it's China or whether it's Russia or whether it's oil, kind of go down the list. But I think what's the bigger takeaway with respect to the volatility framework here is, again, when we look at the 2011 correction, it's a bang and then it's a whimper. It's that initial pop in volatility, and then you tend to get the lower low in the market with much less drama, with much less climactic selling. I think that's what we're setting up for as we move into September and October.
Talk about climactic, you're looking at volume up for the Dow by about 41% versus the 10-day average. That's like peanuts compared to what we saw yesterday, up to almost 200%.